All right. I think things are working again.
I'm going to post it on Facebook.
Okay, thank you. That's super weird. It literally broke everything. Yeah, okay. We are good to go. I'm going to wait a couple of minutes for everyone to join us. I apologize about that. I have no clue what happened.
Yeah.
Thank you. Cool. So we are going to try and pivot over to here. I apologize for whatever in the world happened to my internet there. Let's get started because we have a lot to talk about. I'm not going to go through the intro and all of that again. We're going to be talking today about TIPS, I bonds, and the general idea of inflation protected securities. So I want to get straight into it so that we don't lose any time. So usual disclaimer, we're talking about investments, and today we're also going to talk a little bit about taxes. Please take everything today as educational resources, not as financial or tax advice. Prior to making any investment decisions, do your own research, talk to a broker, or for any tax-related things, ensure that you talk to an accountant and make sure that your specific case is covered by what we're talking about. So the goals for today's webinar are pretty straightforward. We're going to be talking about a type of bond known as TIPS and I bonds. So we're going to talk about what these are, and TIPS being Treasury Inflation Protected Securities, not tips and tricks. And we'll also cover how they work, how they provide returns, and yes, how they can be used as an investment. So before we get into what these inflation protected bonds are, we first need to talk about what a bond at all is. This is wrong type of bond. This is what bonds are. Bonds are a type of investment or an investment asset class. They work similar to an IOU, or if you're familiar with different asset classes, any other debt-based security. If a company or government wants to generate some extra cash, they can choose to issue bonds. Most, but not all bonds have these things. Face value, which is how much the bond is for. So that might be $1,000. That $1,000 is what you paid the company today. The coupon rate, which is how much interest that bond will pay. So as a thanks for lending you their money, or you lending them your money, but also to make sure that they haven't forgot about you, they will pay you interest over time, small amounts, until the maturity date, which is when the face value, whatever that bond was originally worth, is repaid to you. Pretty easy idea. I lend you money. Until you give me my money back, you pay me a little bit every so often so that I know you haven't forgotten about me, but also I get some of my money back, and at the very end, I get that full face value in return. I mentioned the word interest here. I really quickly want to talk about what interest means in regards to bonds. So, to encourage investors to give you or the bond issuer their money, many issuers offer interest payments. So that's that little I haven't forgotten about you money that is paid out to investors. And how much interest depends on if the bonds are corporate or government bonds and the type of bonds that they are. So we're going to start off by looking at something really easy. Treasury bond. For Treasury bonds, the amount of interest is paid annually, equal to the coupon rate of the bond's face value. So what that means is if you have a $1,000 bond and a 5% coupon rate, you'd be given $50 of interest per year. If the bond paid interest semi-annually, you would be given $25 every 6 months. So it is still that 5%, but instead of it being $50 every year, it's $25 every 6 months. Most bonds pay out that way. They will pay out semi-annually at half the percent of the coupon rate. Coupon rate is always annual, so if they pay semi-annually, it's half of the percent 6 months apart. So that is simple interest. Let's also cover compound interest. Compound interest works by, instead of just saying you put in $1,000, you get $50 per year or $25 per 6 months. Instead, every time you get an interest, it goes back into that original amount. Kind of a weird idea until we see it in practice. So let's actually look at a compound interest example. So let's first start with simple interest. $1,000 at 5% interest. Every year we make $50. With compound interest, the first year is the same. By the way, for just simplicity, we are going to be using annual numbers here. Again, bonds do pay out semi-annually, usually. So in that case, we would compound semi-annually. I want to make the example simple, so we are compounding annually here. So for compound interest, the first year, we'd still only make $50, 5%. The second year, instead of getting 5% of 1,000 again, you get 5% of that 1,000 plus the 50 from interest the first year. So now you would get $52.50. Now we have $1,100.50. So the third year, instead of getting 5% of 1,000 again, you get 5% of $11,050 or $55.02.5, making our new amount, if we round, $1,155.53. So you made $5.52.5 more because we compounded instead of did simple interest. And this continues on for the lifetime of that interest. This is the idea behind our Series I bonds. These Series I bonds are a special type of bond that are issued by the US government, known as a savings bond. They have a 30-year maturity that's split into two parts. Part 1 is the initial 20-year term, and then a 10-year extension. And you can redeem them at the 30 years, or you can redeem them anytime after 12 months. So you just need to hold it for 1 year, that's the requirement, and then after that 12 months, you can redeem it. But if you redeem it before 5 years, you lose 3 months worth of interest. Using that example that we had from before, you would lose, give or take, $25, 3 months worth of interest. Or sorry, less, $12.5, because that was 5% per year, so $50 per year. 6 months of that would be around $25. 3 months would be around $12.5. Again, that amount's going to go up as the amount is compounded. But you'll lose 3 months worth of interest if you sell before 5 years. If you sell, you can't sell before 1 year. After 5 years, you would get your principal and all of the interest. And the reason I went through all of that math of semi-annual and compounding and all of that is because I bonds pay out interest semi-annually and the interest compounds. So instead of it just being paid out to you directly, the interest, much like a drip, is reinvested. So instead of it just being now a $1,000 bond, the first year, if it was 5%, it would be $1,050. Then after that, go up and up and up and up over time. So that's the idea behind Series I bonds. Let's now talk about their interest rates, because it's not as simple as just saying, you give me $1,000, I give you 5% compounded semi-annually for 30 years. It's not as simple as that, because the amount of interest that an I bond pays is based on two things: the fixed rate and the inflation rate. The fixed rate is the exact same as a coupon rate on any bond. When you buy the bond, they say, here's the amount of interest you get. We will never change this interest rate, for most bonds, by the way. Some bonds do change interest rates. Here, the fixed rate is fixed. It does not change. Then, this fixed rate changes every 6 months. When you buy the bond, it does not change. But if you were buying for the new buyers, the new people that want to come in and join the party, their fixed rate will change. And whatever the fixed rate is at the time they buy that bond, that's what they get. This rate changes every 6 months. The first business day of May and the first business day of November. So for this year, because Monday, May 2nd is the first business day of May, that is when the new fixed rate will be announced. Then the next one will be on November 1st, being a Tuesday. Now, again, like I said before, once you buy that bond, you are locked in. That rate is what you get. So, we are here. It is 4:20 on March 18th of 2022. What is our fixed rate for the I bonds? %0.00%. I'll start taking money now. Thank you very much. Who wants their 0.00% return? You? You? Juan? No? So, where's the return? How do we make money if the interest rate that you're getting is 0%? Well, that's the fixed rate. The inflation rate is where the profit's actually realized. So this inflation rate, the word inflation here is not some weird name, it's not some weird idea that is unrelated to the inflation you probably know of. The inflation of the US economy. My dollar is worth something today. What is it going to be worth tomorrow? How are prices in the economy changing? That is inflation. And much like the name inflation rate implies, it is tied not identically but closely to the inflation rate of the US economy. To do this, the Treasury Department uses something called the Consumer Price Index for urban consumers. What that is it looks at the cost of things of urban consumers, being people that are part of the economy. They spend money, they make money, and then they spend money again, that live in urban city centers. Prices, if you're out in rural, farm, mountain, not in a city, those prices are going to change pretty wildly. So to keep it pretty simple, they leave it at cities. For the people that live in cities or metropolitan areas, what is the cost of stuff? This is maintained by bls.gov. And here is the current consumer price index. Let's bring that over here and we can check out what it actually says. We have relative importance, which is what is the weight of this group? How important is this group in terms of your overall consumer spending? So food, 13.38%. All items minus food and energy, 79.2%. Energy, 7.4%. If you live in San Diego, that's way higher because our utility costs are absurd. That's not the point of today. You kind of get the idea looking through this of where are people spending their money, and then what is the price of that category? So something that has a weight of 13% is going to matter more than something that has 0.76%. The next thing we have is the unadjusted indexes. These are looking at how has the price of that index changed. And then over on the right, we have the change from the same month of last year compared to the change of this year. Compared to the change of this year and the month-over-month change, last month to this month. All of this is put together to give us the CPI-U, or the Consumer Price Index of urban consumers. Like I said, this index tracks consumer spending, what we spend, where we spend it, and how the prices of our spending has changed. Currently, the inflation rate for I-bonds is at 7.12%. That means that I-bonds pay 3.56% interest per 6 months, compounded every 6 months. So while the fixed rate doesn't change, remember that is, as the word says, fixed. The inflation rate for your I-bonds does. That rate changes every 6 months. When? On the first day of May, or the first business day of May, and the first business day of November. That is when the rates change for the fixed rate, but also the inflation rate. Now, what would happen if you bought a bond on January 15th? Well, the new rates would affect you like this. You would be affected if you bought in January, you'd go back to the beginning of the month. January 1st is when those rates would affect you. July 1st is when those rates would affect you. It means if you bought an I-bond today, you would be given the rate of January 1st, meaning your first semi-annual interest payment would be for the 7.12% currently. As long as you buy before the last day of April of this year, you would get that first rate. If you're ever interested to see what those rates actually are, the website where you would buy these bonds through, which is treasurydirect.gov, keeps a list of all of the prices, or all of the rates. Let me get you all the link for that right now, because it's really interesting to get to see how the rates change over time. Where is the chart? Here we go. So that link right there will take you to this, which is when do your bond rate change? That's not correct. When do the rates that you receive change? When do the rates update? But also a history of all of the updates and what they were. So, is this rate actually good? To answer that, let's go and take a look at inflation returns, or I-bond returns, wow, since 1998. Almost as long as I've been alive. Here we see the blue is the fixed rate amount. It's kind of gone down, and it's bumped up every now and again, all right? It's not always 0%, but it's been usually 0% for about the past decade. Oh, whoops. The red line is the semi-annual inflation. That is the amount of the inflation rate that you would receive every 6 months. And the yellow line is squishing those two together to get your annual interest amount. So while I-bond interest has decreased since the dot-com bubble, about the past 14 years or so, the rate has really only gone up or down a total from the highest to the lowest in the last 14 years, 0.72%. But the fixed rate has been less than 1% since 2007, and since May of 2020 has been, like I said before, 0.00%. So, back to the question. Is 7.12 annual percent return good? Yes, but remember one thing. This return will follow inflation. So if there's more return, so there will be more return when inflation is high. It's supposed to keep up with inflation. And less return when inflation is low. That is the real value of I-bonds. When inflation rises, if you have a $10 bill, that $10 bill is now worth less. You cannot buy as much with a $10 bill today as you could a year ago, 2 years ago. Again, I like to look at it in terms of how much does my Chipotle burrito cost. My Chipotle burrito, when I started going there, was about $8. Now, if I want guac, the price of guacamole is almost as bad as, or is almost as much as what I used to pay for the entire burrito. So I don't get guacamole in my burritos anymore. But no, the price of things goes up over time. And that is normal, that is expected, and the Federal Reserve likes inflation. It is healthy to have a little bit of inflation. So I-bonds are meant to help you with that. Instead of just putting your money into a savings account that may or may not give you a little return, we're talking less than 1%. If inflation is higher than 0.5%, you're technically losing money because the money is just sitting there. That, where is it? That $20 bill that you had, this right here is losing money right now. that is how inflation works. My money today is worth less than it will be, my money today will be worth less tomorrow because inflation is going up and the Federal Reserve wants it to go up. Now, here are a couple important notes on I-bonds that we really do need to cover. Again, this is all talking in most of the time kinds of situations. There are rules and exclusions and fine print everywhere here. Welcome to tax code. Do not take anything here as, well, Jonathan said that this is how taxes work. No. Talk to an accountant before making any decisions like this. Taxes are not something to mess around with. They're complicated. There are little cases here and there that change the rules. Always check with an accountant before making any decision when it comes to taxes. With that said, in general, I-bonds are exempt from state and local taxes. They are federal treasury things bought through federal treasury, and the federal side of things usually likes to let the state and local do their thing, and the state and local like to let the Fed do their thing. Because of that, I-bonds are exempt from state and local taxes, but not exempt from federal taxes. They are federal securities. You pay federal taxes. But remember, you don't get a check in the mail from good old Uncle Sam, or his wallet, I guess, with here's your interest for these 6 months. Instead, he reinvests that money for you. So you don't see a single penny of that until you redeem that bond. Because of this, you can choose to take that taxation annually, or you can choose to defer all of the tax payments until you actually redeem that bond. Now, here's where things get interesting, because I-bonds are tax exempt, meaning they're not subject to tax, if they are used as part of to pay for higher education, so usually college, and stored in an account like a 529 plan that is meant for qualified higher education. I use this word here, qualified, as a very important word. Not all higher education is qualified for tax exemption. Again, why it's very important to talk to an accountant before making any decisions related to taxes. Looking beyond taxes, there's one thing I want to say here, and this is why people look at I-bonds and say, these are a cool investment. I want to consider this. The return of an I-bond can never go below 0. When you redeem that bond, if inflation has gone up, or if inflation is up, that means that you will be making interest on that inflation. So you will get your principal amount, so the face value plus all of your interest. If the economy deflated, then you would technically lose money, but you are always guaranteed that principal. The face value you are always guaranteed, whichever one is larger. Seems like a good deal, right? 7.12% return, some tax exemptions if stored in certain accounts, and you technically can't lose money provided Uncle Sam doesn't run out of money and go belly up. So what are the downsides? Because this isn't just free money. Uncle Sam isn't just giving you free money. there's always a catch. In the case of I bonds, you are required to hold them for at least 1 year. If you hold it for less than 5 years, you lose 3 months worth of interest. Then, if you hold it beyond that, you get the full amount. The other is that you're limited to how much you can actually buy. Every year, you are only, per person, you are only allowed to buy $1,000 worth of I bonds, and you can buy up to $5,000 of additional I bonds from your federal income tax return, refund. So the IRS gives you money back. You can choose to take that as cash, or you can choose to take it as I bonds. Now, let's go back to that 7.12% number I said. Seems like some pretty easy money. Right now, for the 6 months, 7.2% return per year. That's good until you remember that the actual inflation rate for this past month was 7.9%. The actual inflation rate for the past few months has been above 7%. If we were to look here at the inflation rate for the past year, December of 2021, 7%, January 2022, 7.5%, February of 2022, 7.9%. So, are we making money here? No, we're losing money compared to inflation. Because if you invested $100 into an I bond, yes, it would give you 7.12% return per year, but it's not beating inflation. So after that year, that $100 bill is worth less. Even with the interest, it is still worth less than where you started. And keep in mind, every dollar you spend or don't spend is an opportunity. If you put your money in a savings account, it means you can't put your money in an I bond. It means you can't put your money in stocks. If you put your money in an I bond, it means you can't put your money in a savings account, and you can't put your money in stocks. That means that you technically always have the option of using this money to invest in stocks. If you think you can beat the return or beat the inflation rate, then you always have the option of taking that money and instead of putting it in an I bond that you know the return, but the return might be less than the actual inflation rate, you can invest it in the stock market. And you might end up making more return or not. There's no promise of any money here. There's no such thing as free money. And this is no exception. But again, if we're going to say that we can't beat the stock market, or we're going to say that we can't beat inflation, remember the other option. You might miss inflation by, in this case, 6.8%. 7.8%. But this $20 bill, it's losing value by 7.9%. The money in a savings account, even if you get the best rate that there is right now, there are multiple banks that offer high yield savings accounts of 0.5% return. That is still significantly lower than inflation, which means any money you have in a savings account is losing value. Yes, you make interest, but when that interest is less than inflation, you're technically losing money. Now, that is I bonds. Let's now talk about TIPS. Similar, but different, and is good that we have these options. TIPS, much like I bonds, are inflation-protected securities. They are similar in that they are bonds that have a face value, have an interest rate, and have a maturity. But unlike I bonds that can only be bought through the US Treasury at Treasury Direct, and I bonds that have a limit of $10,000 per year, TIPS can be bought on secondary securities markets. What that means is through your broker, through Treasury Direct, and through Treasury Direct, there is a limit of $5 million. It's a little bit more than 10,000. Additionally, TIPS do not have a minimum holding requirement. Minimum holding requirement was that you have to hold it for 1 year. You lose 3 months of interest if you hold it for less than 5 years. There's none of that. There's another difference. TIPS, instead of adjusting for inflation semi-annually, like I bonds do, they adjust for inflation every month. However, unlike I bonds, TIPS are subject to federal tax, and they can only be deferred, which means every year, yes, that interest is reinvested, but you can't defer all of those interest payment, like taxes on that interest, until you redeem it. You need to pay off those taxes every single year. And the only way those taxes can be deferred, pushed off, is if they're held in a tax-deferred retirement account. The last comparison that I have here between I bonds and TIPS are actually similarity, not a difference. I bonds can only ever return the minimum of the principal. So if you hold the security to its maturity, the minimum it can return is the principal. But you wouldn't, if you want to get rid of it early, you don't redeem it to the Treasury Department. You would sell it on those second markets, those secondary securities exchanges. That creates some problems. It makes it a little bit trickier because you can only ever return a minimum is if it's held to maturity. If it's not held to maturity, there's no protection against loss. So by that, we can answer this question: do TIPS always beat the market? No, not always. Yes, if you hold a TIPS to its maturity point, most of the time 20 years or 10 years or 5 years, you are guaranteed to get at least your principal back. However, if you choose to sell early, you may actually sell at a loss. So you might have bought it for a certain price, and if things don't go your way, you might end up selling for less. You can lose and have negative return from TIPS because the only protection is if you hold it through to maturity and have Uncle Sam give you that original amount back. Now, if we're trying to think about monthly inflation, and we adjust for inflation monthly, shouldn't we always make a profit? Well, no. Because tips try and predict inflation. They don't react to inflation. They try and predict what is going to be the inflation for the next month. Yes, what you had for dinner yesterday and the night before might change what you have for dinner tonight, but you never know until you actually start making that food. So tips try and predict the changes in inflation. If inflation is higher than expected, tips will yield higher interest rates. If inflation is lower than expected, they will yield lower interest rates. And because of that, their return, how much you would profit or lose, also changes, depending on which direction and how much the prediction was off from the actual inflation. We've been talking now for about 40 minutes about this topic, and it's a very detailed topic. There's a lot of options, there's a lot of considerations. There's no such thing as zero risk. There's always some risk in investing. So if this has given you any paralysis by analysis, I have something for you. Because there is an easier third option here. There's I-bonds, there's tips, and because tips can be bought and sold on secondary markets, there's also tips ETFs. There are a few ETFs that invest in tips, and some of these options include iShares 0 to 5 year, which is the ticker symbol STIP, Vanguard's short term, which is VTIP, Invesco, which is PBTP. Try saying that one 5 times fast. So, with all of these choices, it makes it a lot easier when you're thinking about if tips are something that are interesting to you, to let someone else manage it. Let someone else handle the buying and the selling and when to buy and when to sell. So there is one last thing that you need to be aware of, because this is the part of the economy that tips interact with. The spread. It's what is known as the spread. Remember that investing in tips or tips ETFs or I-bonds even are an opportunity cost. Means that you cannot invest money somewhere else. So when you're looking at the opportunity cost and you're asking yourself, is it worth it to put my money into tips instead of into treasury notes or into stocks? You've got to have something to look at. And that's where we have the tips spread. The tips spread compares the return of 10-year tips to something else that's low risk but moderate to low return. 10-year Treasury notes. Treasury notes are a fixed return. They are not inflation protected. Tips are. So when you want to say, would I be making more or less if I put my money into Treasury notes? We can use the tip spread for that. Currently, the spread is at 2.84%. What that means is that we would have a better return with tips if inflation is above 2.84%. If inflation is lower than 2.84%, we would have made money more money investing into 10-year Treasury notes. That's what that number means. Above 2.84% inflation, we would do better with TIPS than we would with T-notes. With less than 2.84%, we would have done better with fixed rate T-notes than with TIPS. So now we have to ask the question that no one can answer. Will inflation stay above 2.84%? When we look at last month or the last year, inflation's been above 2.84% for actually 1 year now. But will it stay there? We don't know. Since 1960, the average annual inflation rate has bounced between around 1% to 3%, with some pretty large spikes in the 1970s and 80s, and also in 2021, and into current day right now, March 2022. An organization sits above our economy and tries to change policy and what they can to keep our economy happy, to keep it healthy. So the Federal Reserve has a long-term goal of, like I said before, keeping inflation going. Inflation is healthy because if I know that my $20 is going to be worth less tomorrow than it is today, guess what? I want to go and spend this $20. It's going to be worth less tomorrow, so YOLO, let's spend it today. Woo! But that's healthy. This is not healthy. So what do you do when something's not healthy? You take it to the doctor and you try and get it back to being healthy. This past week, the Federal Reserve had its doctor's appointment, or had its appointment with the US economy and prescribed it a small change. They started changing something called the Fed funds rate. That is the rate that sits below everything in the US economy. It is the rate at which banks can lend to other banks, and from there, everything else sits on top. So if we raise the bottom, all other interest rates are going to raise as well, which is going to change spending, and it's going to cause a little bit of deflation. This is one of the Fed's tools that they have to increase or decrease inflation. And by the Fed increasing the federal funds rate, it is aimed at reducing or decreasing inflation. We know that this is what they are trying to do. They are trying to lower that inflation from 8% back closer towards their 2% goal. Remember that the TIPS spread is currently at 2.84%. So anything above 2.84%, your returns are going to be better with TIPS than they would with T-notes. If it falls below, you'd be better off with T-notes than you would with TIPS. So with this change, how is inflation going to be affected? I have no idea. We know that it will be affected, but we don't know how much. And the Fed also does not know how much. That is the reason that the Fed did not just hike that rate all the way up, throw a Hail Mary into the end zone. They just went for a little bit. A very, very small, just little nibble to test the waters and see how the market would react. how inflation would react. The US economy is big. It takes a lot to move it. But when the Fed says jump, the economy doesn't say, should I jump? They just say, how high? So now we need to see, the Fed said jump, we'll see how high the economy goes. And by that, we mean how low inflation shifts. So we've talked about a lot today, and I just want to bring it all back together in one small digestible bit. TIPS and I bonds are two very valuable long-term investment options. Inflation is not a bad thing. It is expected and it is encouraged. So these options give us ways of protecting ourselves against inflation. While these options may return little, if any, profit, they're not meant at being your revenue generator. You're not going to retire and live off of your earnings from tips as your primary way of making money. But if what you're looking for is something with little risk but protection against high periods of inflation, TIPS and I bonds are a very valuable consideration. The tax liability and how you pay taxes depends on which option you choose. I bonds, you can defer the tax. TIPS, you cannot. I bonds, you have to hold for a minimum of 1 year. TIPS, you can buy and sell as you please. For TIPS, ETFs do exist to simplify the buying process and take out a lot of that worry. However, both of these assets are tied to the US inflation rates. It doesn't care if it's super high or super low, it needs to be predictable. The more predictable, the more predictable the returns will be. So when the Fed announces, like they did, that they are changing interest rates, we may see large changes in inflation, we may see little change in inflation. But the process for adjusting our inflation has begun, and there's no telling where things will settle. So we will likely see some changes in the returns, but also the viability and how worth it using I bonds and TIPS really are, as we start to see how inflation changes moving out of this pandemic, back into a healthier economy, and what place these options will have in terms of long-term investment possibilities. So that is the topic for today. I hope you guys all enjoyed today's presentation about a very interesting, underutilized, but very interesting topic, especially now given what's happening with the Federal Reserve and the federal funds rate. This is going to be a word, inflation protected. You're going to see those words used very frequently as the interest rates change and inflation shifts. Now you know a little bit more about what's going on behind the scenes when they say inflation protected. You know what they are, and you know what makes them different. Before we end today's webinar, I just want to remind all that are interested that right now, today is the last chance that you have to buy a Sectors Made Simple subscription using the promo code that we have. Kira and I got married last week, and to celebrate, we offered for 1 week, ending today, a 6% discount. We've been together for 6 years, so 1% for every year we've been together. A 6% discount on your first period's payment. So if you get a year subscription, it's 6% off your first year. If you get a 3-month subscription, it's 6% off your first 3 months. This is, again, today is the last opportunity for this. So if you're interested, you can purchase a subscription now on our website, sectorsmadesimple.com, by using the promo code WEDDING2022. So, thank you all so much for joining us today. If you have any questions about purchasing a subscription or topics that you'd like to hear us cover in a future webinar, you can email us at support@sectorsmadesimple.com. As a reminder to subscribers, we will have a webinar this upcoming Tuesday. For everyone, we will not have a webinar this upcoming Friday. So we will be back here with you all on April 1st, where I will get to share with you all a very fun announcement about something, not just an announcement, a reveal of something that we've been working very hard on behind the scenes, and I think you all will enjoy, because it is all aimed at helping you to invest, not just in general, but with sectors made simpler. So thank you all so much. Have a great weekend. I'll see you all on April 1st. Subscribers, I will see you all for our next webinar this upcoming Tuesday. So thank you all so much. Take care.